everything settled down from this spinoff. This is something that's intriguing to me because it is definitely one that I'm curious. Man, the book value is incredible here. This is the lifeblood of the business. Today, we're going to hit 3 stocks that are at 52-week lows. Now, just because a stock is at a 52-week low doesn't mean it's a buy. You can have a stock price that does some kind of crazy run-up due to COVID maybe, and it comes down and it falls in half. And that could be a 52-week low, but it may need to fall in half again for you to grab it. So remember this as we're going through. And if you don't quite understand that yet, don't worry. Let's get through a little bit of this. And there's going to be a couple in here that are great examples. So the first one I want to look at, Warner Brothers Discovery, WBD. And the reason I want to look at this one is it's been requested quite a bit. There was that major spinoff that happened from AT&T. AT&T was kind of able to shift some of their debt over to WBD. Now, when we go and look at certain things, especially on the 8 pillars, it looks really bad. But a lot of this has to do with the deal settling down. People come and they look at the book value and they say, man, the book value is incredible here. This is a screaming deal. But is it really a screaming deal? So let's get into it a little bit. So the PE, I'm not concerned about this really, just because everything's settling down. It's very difficult for me to go, oh, the PE, I'm out. But there's other aspects of this that I don't like, namely, still the debt situation. This has been an incredible thing that's been going on with both AT&T and now Warner Brothers Discovery. And for me, that debt situation right there is very, very scary and makes me very apprehensive to invest in something like this. Also, the 5-year ROIC. I like companies that return capital on themselves, and they do it in a very efficient manner. In the media industry, you don't really see that. They invest in themselves, but they don't really get that great return, as you'll see with an Apple, a Microsoft, a Google, something like that. So let's get into shares outstanding. This doesn't worry me at all. This is because the spinoff. Let's go over and I'll just actually show you on the income statement. So let's scroll all the way down here to shares out, and you can see what went on here. 381 million shares, big dilution here, and then all of a sudden they had a big jump from 589 million to 2.43 billion. That was that spinoff that happened. So everything that I'm seeing just at a very surface level makes it very hard for me to invest. Also, look at this. And the reason I'm saying this is I want things to settle down. If you guys have watched previous videos, I've said I kind of want to see 3, 4, 5, 6 quarters of WBD doing it on their own and let everything settle down from this spinoff. It's hard for me to look at this and go, okay, they had growth. They went from $12 billion in revenue to $26 billion. Now I'm going to say, okay, are they going to go to $27 billion or are they going to go to $12 billion or are they going to go to $15 billion? I don't know. That's something that I need to see. So I want to kind of get another year under the belt. Net income is probably the same situation. On their own, they were making the money. Well, except for 1 year here. Could have been something that they did in 2018. But now they're losing $5 billion. Again, back to the spinoff. So all in all, I've said this a million times. Because of what happened with WBD, in my opinion, I'm waiting. I'm waiting just to see where the dust settles with this company. Next company, Palantir. It's been one that we've talked about for quite some time, and now it's at 52-week lows. It hit a high, all-time high, on January 27th, 2021 of $45, and this is when a lot of people were screaming, buy, buy, buy. Even when this thing fell to $20, which was a very big fall from 45, we were still saying, not even close. Not even close when it was right in here. Even when it fell to $10, we were saying, it's getting there. It's certainly getting there, but right now, at $6, and its low, which was at $6.04, it's getting pretty close. And the reason is, why? Well, the 8 pillars, there's not enough data here. And usually, this is a great example, actually. When Paul and I look at something and you guys see that there's not enough data, we usually say move on. But remember, 8 pillars is not the only thing that you look for. Let's dig a little bit deeper and see what's going on here. Namely, let's go over to the cash flow statement. And this is something that has intrigued us recently. Let's go to quarterly, just so you can see this cash flow growth. So 8 consecutive quarters, 1, 2, 3, 4, 5, 6, 7 consecutive quarters coming into the 8th. They have had positive free cash flow. Positive free cash flow. And this is the lifeblood of the business. If you have cash, you have a lot of options to do different things. Coupled with this, come down to their shares outstanding. It almost looks like they've gotten to the point where they're going to stop diluting shareholders. The debt situation, it looks like they're at the point now that they have cash that they don't need to go and borrow on debt. I actually was talking to somebody last night and he does sales for Palantir. He was telling me about the company on different levels. It sounds like a very intriguing company. So for those reasons, this is something that's intriguing to me. Now, it is at a 52-week low, which makes it even better. And the great thing about 52-week lows, when a stock is at $6, people want to beat it up even more, and they could take it to $4. And maybe this is a great opportunity to go sell puts if this is something you believe in. Something else here, total current assets of about $3 billion, total liabilities of $932 million. So they can pay off all of their debts and they still have cash on hand, which is a fantastic thing, especially for a company of this stature. All right, last company. You know what? Let's see before we go on to the next company, I just want to see what the analysts are saying about this. So look at the growth. Look at the earnings per share growth. They see this going from 5 cents a share this year to in 2026, $1.43. That's massive growth. And on the revenue side, about $2 billion to about $3.75 billion. So this is something where the analysts aren't the end-all be-all, but they're definitely saying, hey, this thing has some potential. Also, there's a shift going on right now. So they do two things. They have government contracts. They work heavily with the government, and they have commercial contracts, which is businesses. And before, it was heavily reliant on government. It was more than 50%. Now, this is about 45%. So they're kind of shifting towards that commercial side. I really like that. I don't think that they should step away from government, and they're not going to. But I like that they're kind of making that shift towards the commercial side. I'm not a huge fan of businesses that rely on the government. And this is proving to me that they're not that kind of business, which is an awesome thing for me. All right, last company. And if you're looking at this and saying, what the hell is this guy looking at? Just keep watching videos, guys. Just stick with me here. This one I'm going to run through Stock Analyzer tool. Even though this Amazon is at $86.50 a share with an all-time high of $188.65 in July of 2021. Remember, this did a big split. This doesn't seem like a screaming deal to me, and I'll show you exactly why. Let's go here to the 8 pillars. I mean, for a company like, I was talking about this company with Paul yesterday, and I was saying, maybe I'm going to go and sell some puts here. And then I was like, maybe I'm not, because this company did in the holiday quarter, they did $150 billion of revenue, okay? And they broke even. They broke even during the holidays at doing $150 billion of revenue. I don't know what more they can do to be profitable. Their margins are absolutely terrible. Let's look at their margins here. Profit margin, 2.3%, 5-year profit margin, 4.2%, and a gross profit margin of just under 13%. Their debt they're spending like crazy on planes. This is just from the shipping side. Planes, delivery trucks, people. Don't forget that they doubled their labor force when COVID happened. The ROIC, I'm very underwhelmed by this. Yes, it's almost 9%. It's pretty much there, but I expect a business like Amazon to have a higher ROIC, and we don't see that. So let's go, man, and they're still this overpriced, and there's a massive discrepancy between the 5-year PE ratio and the 5-year price to free cash flow. Massive discrepancy. All right, let's check out their cash flow while we're at this before we run over to Stock Analyzer tool. So they had negative free cash flow this year, 2022. I don't know why. I'm assuming massive negative free cash flow. Let me go to their acquisitions. So they did a $8 billion acquisition this year. So this is something that scares me, guys. This is acquisitions and dispositions. So if there's a negative in front of it, that means they bought something. If there's a positive in front of it, which we do not see, that means that they divested something. So in the last few years, $8 billion, $2 billion, $2.75 billion, $2 billion, $2 billion, $14 billion, and the list goes on. So they spend a lot of money acquiring other businesses. And some of them, like their medical one that they just had purchased recently, Med something, they just completely canceled. They just said, we're done with this. They acquired it and just said, we'll take the loss on it. They'll probably write it down next year. Let's look at some analyst estimates on Amazon. Now, you would think it's Amazon. They ship everything. They're going to have huge growth. Well, yeah, analysts are seeing that. They're seeing negative earnings per share in December of 2022 to about $20, which is huge, absolutely huge. On the revenue side, probably high single-digit growth, But does that growth translate to profit? That's the big question here. So let's run this one through Stock Analyzer tool because it is definitely one that I'm curious. Going back to the conversation I had with Paul, I looked at this and said, hey, maybe if it's $50, I'll buy it. But then I said, maybe that's not cheap enough. Maybe $40. And I got down as low as $20 and said, is $20 dirt cheap for this? And the concern was the margins and the debt. So let's run this through Stock Analyzer. And we're going to do a 10-year assumption here. So let's say over the next decade, they do 3% revenue growth on the low end, 6% in the middle, and 9% on the high end. This is over a 10-year period. Their margins, profit margin, I'm going to go with 2, 3, and 4. 4 on the high side. Free cash flow margin, it's certainly different. So, I'll go 1, 2, and 3. And I think 3 could be high, but let's leave it. Now, PE. Guys, this is almost $1 trillion company. They were a over $1.5 trillion company at one point, I believe. 77.5 PE currently. I'm going to give them a PE of 15, 17, and 19. And I think 19 is incredibly high. I'll do the same thing for the price to free cash flow. And my return, I'm going to go 12.5 on the low end, 15, and 17.5 on the high end. And why did I change those numbers down there? Well, this is my margin of safety. I'm saying that if I invest in this, especially if I'm looking for 9% revenue growth and 4% profit margin over the next 10 years, I really need to get some kind of good return. So I'm going to say I need 17.5% return on my money. Now, on the low end, do I think they can do 3% revenue growth? Yeah. Profit margins of 2? Yeah, I do think that. With a multiple of 15? Okay, I'll do that and I'll get 12.5% return on my money. It's going to beat any ETF. I have to make the juice worth the squeeze. All right, let's click Analyze. Current price is $86. And here's your numbers. And kind of this is where I was sitting in my head yesterday when I was sitting on my couch playing with Amazon. I'm looking anywhere from $6 to $12 and basically 23 to 30 on the high end. And I know you're looking at this saying, Mo, you're crazy. This is Amazon. They sell everything in the world. I understand. I really do. But you have to understand that when I look at these metrics right here, this scares the heck out of me. This absolutely scares the heck out of me. This return on invested capital, these scare the heck out of me. When I look at their, guys, there's just so many things that I look at here that I'm just saying, man, I just don't know. When I look at their debt situation, these are my 8 pillars that I put in here. So I put in, we have the EM 8 pillars. Then I put in my own 8 pillars. I lowered the PE a little bit. I increased the ROIC. I wanted to achieve some type of dividend. And I put a market cap of greater than $10 billion. And for me, even those numbers are not hitting, even though it makes sense that they're not hitting. So guys, all in all, if you like this kind of analysis, subscribe to our channel. Understand that just because stocks go down doesn't mean that they're a good buy. Have a great day.